At some point, reality changed. Not all at once. Not with an announcement. Not with a vote. Prices began rising even when demand didn't. Crises stopped being temporary and became permanent. Debt grew larger, yet everyone was told it didn't matter. Money appeared from nowhere, and we were assured it was normal. Here's the mystery. How did a small group of institutions gain the power to redefine what money is, value means, and what reality looks like for entire nations without most people noticing? And more unsettling still, what if the rules you believe govern the economy no longer exist? To understand how central banks quietly rewrote the rules of reality, we have to start before money lost its meaning, back when it still obeyed limits. For most of human history, money was restrained by nature. Gold had to be mined. Silver had to be refined. Value was slow, physical, and scarce. Governments could not simply create money. They had to earn it through taxation, conquest, or trade. This scarcity imposed discipline. Wars were expensive. Debt had consequences. Inflation was feared, not managed. Banks existed, but they were constrained by reserves. Lending was limited. Failure was possible. Reality had rules. But as nations grew larger, wars became more expensive, and populations more demanding, those rules became inconvenient. And inconvenience is where central banks enter the story. The original purpose of central banks was not control, it was stability. The Bank of England, founded in 1694, was created to finance war. In exchange for lending money to the crown, bankers gained influence over currency issuance. This model spread. Central banks promised order, a lender of last resort stability during crises, protection against bank runs, and for a time, it worked. But embedded in this system was a quiet shift. Money creation was no longer tied strictly to physical limits. It was tied to trust, debt, and centralized authority. Fractional reserve banking allowed banks to lend more money than they actually held. Central banks stood behind them, promising rescue if things went wrong. Risk was softened, consequences delayed. Reality began bending slowly. The 20th century accelerated everything. World War I shattered the gold standard temporarily. World War II weakened it permanently. Governments borrowed at unprecedented levels, and central banks enabled it. By the mid-20th century, money was increasingly abstract. Paper claims backed by promises, not metal. Then came the pivotal moment. In 1971, the United States ended the convertibility of the dollar into gold. The world's reserve currency was no longer anchored to anything scarce. This was not just a financial decision, it was a philosophical one. From that moment on, money was limited only by policy decisions. Central banks became managers of perception, not just currency. Inflation was no longer failure. It was a tool. Debt was no longer danger. It was leverage. Growth was no longer organic. It was engineered. Reality was no longer discovered. It was administered. Here's how the rewrite worked. Central banks learned that controlling expectations was more powerful than controlling resources. If people believed inflation would stay low, it often did, temporarily. If markets believed rates would stay low, asset prices surged. If governments believed debt could be rolled forever, discipline disappeared. Money creation stopped being tied to productivity. Prices stopped reflecting scarcity. Risk stopped being priced honestly. Central banks began smoothing cycles instead of allowing correction. Every downturn was met with intervention. Interest rates fell, liquidity increased, balance sheets expanded. Each intervention distorted signals slightly more. Reality became curated. The breaking point didn't arrive with one crisis. It arrived when crisis stopped ending. After the 2008 financial collapse, central banks faced a choice: allow failure or prevent it at any cost. They chose prevention. Interest rates were pushed to zero, then below zero. Trillions were created digitally through quantitative easing. Central banks began purchasing government bonds, corporate debt, and even equities. Markets no longer reflected value, they reflected policy. Failure was no longer permitted. At that moment, reality officially changed. Prices went up even when economies stalled. Asset bubbles became permanent. Inequality widened, not by accident, but by design. Central banks were no longer referees, they were players. The fallout wasn't immediate. That's why it worked. Savers lost purchasing power quietly. Wages lagged behind prices. Housing became unaffordable. Speculation replaced productivity. People worked harder, yet felt poorer. Meanwhile, those closest to money creation benefited first. Asset holders gained. Debt holders were rescued. Institutions grew larger. This wasn't corruption in the traditional sense. It was structural favoritism embedded into monetary design. Reality had been rewritten to reward proximity to liquidity. Every attempted fix deepened the trap. Raising rates threatened collapse. Lowering rates fueled bubbles. Printing money stabilized markets and destabilized lives. Central banks became prisoners of their own interventions. They could not stop without causing pain. They could not continue without distortion. So they chose narrative management. Inflation became transitory. Debt became sustainable. Currency debasement became stimulus. Words replaced limits. Reality was explained, not fixed. Look at today. Central bank balance sheets larger than national economies. Debt levels exceeding historical records. Markets reacting more to speeches than fundamentals. Every crisis follows the same pattern. Shock intervention, expansion, normalization, dependence, the numbers grow. The consequences are delayed. The rules shift again. What once would have been unthinkable is now expected. Reality adjusts downward. Here's the uncomfortable truth. This system didn't fail accidentally. A debt-based global economy requires constant intervention. Without expansion, it collapses. Without inflation, it suffocates. Central banks didn't just rewrite reality. They adapted it to survive. The cost was invisibly transferred from institutions to individuals. From present to future, from transparency to trust, money is no longer a neutral measure. It's a policy instrument. Markets no longer signal truth, they signal intervention. Understanding the system matters more than following its advice. Here's the warning. When reality is managed instead of measured, stability becomes an illusion, and collapse arrives without warning. The open question. If central banks can redefine value, risk, and money itself, what else can be rewritten next? If you want to understand the systems shaping your future before they change again, subscribe. Because the most important rules are never rewritten out loud.